Hello, in this video, we're focusing on the practical concepts that you can actually apply in the real business world. Hope you enjoy it. Let's get on with it. Today, we're going to explore the significant shift in Shein's logistics strategy that is setting the stage for their anticipated multi-billion-dollar IPO in 2026. As one of the fastest growing fashion retailers worldwide, Shein has revolutionized fast fashion by using an innovative supply chain and logistics model that allows them to get trends from design to delivery incredibly quickly. Behind their growth is a massive, carefully planned pivot in how they manage inventory, shipping, and production, all of which supports their goal of scaling globally and attracting major investment. You might recognize the Shein brand from its strong presence in both online marketplaces and fashion events, reflecting its rise as a major player in the retail space. This presentation will unpack how these logistical changes are not just operational tweaks, but a strategic foundation enabling Shein's ambitious market move. The real story behind Shein's growth isn't just the trendy styles or its strong social media presence, but a fundamental shift in how it manages its supply chain. As Shein prepares for a 2026 IPO, valued at around $66 billion, investors are looking beyond the surface of fast fashion and focusing on this logistics transformation. The key question is whether Shein can move from being a quick exporter to becoming a hybrid logistics platform that controls more of its delivery and fulfillment processes. This shift is critical because it could allow Shein to scale efficiently and expand its profit margins, justifying a premium valuation in the public market. Understanding how this supply chain innovation drives Shein's competitive edge is essential to grasping its long-term potential. Shein's shift from a cross-border dropshipping model to a distributed regional fulfillment system is a major strategic move aimed at supporting long-term growth. This change is essential for expanding margins as it improves logistical efficiency and lowers costs, which investors see as a sign of stronger financial health. At the same time, it helps address regulatory and geopolitical challenges by localizing operations and reducing exposure to risks associated with international trade tensions. Investors are paying close attention to how mature and robust Shein's logistics platform is, recognizing that this underpins the company's ability to sustain its growth. The potential for margin expansion also contributes to a higher valuation, while faster delivery times create a competitive advantage that's difficult for others to replicate. Overall, what's really being valued here is Shein's logistics maturity, financial upside through margin improvement, ability to scale globally, and how well it manages external risks. The first goal is to reduce regulatory and political risk by shifting away from fragile cross-border shipping. By localizing inventory closer to customers, the model avoids issues tied to customs and import thresholds, which are increasingly under scrutiny. Next, improving delivery speed is critical. The plan moves from delivery windows of 7 to 15 days closer to the kind of rapid 2 to 5 day delivery that companies like Amazon offer. This boost in speed enhances customer satisfaction and competitiveness. Expanding gross margins is another key objective, achieved by replacing costly per-unit air freight with bulk regional imports, which are more cost-effective and efficient. Strengthening the investor narrative is also important because public markets favor businesses that demonstrate scalability, predictability, and defensibility. Finally, improving inventory management through a hybrid stocking approach helps reduce lost sales caused by stockouts, ensuring better product availability and customer experience. Together, these 5 objectives form the backbone of a rebuilt model tailored for public markets. Shein's legacy model was built around a near-pure cross-border fulfillment system, where products were manufactured in small batches in China and shipped individually via air freight directly to consumers. This approach allowed them to keep inventory risks very low, thanks to ultra-fast production cycles, supporting an extremely broad range of SKUs and quick responsiveness to trends. However, this setup also carried some significant limitations. Shipping costs per unit were high due to air freight, and customers often face delivery times ranging from 7 to 15 days. There was also constant exposure to customs disruptions, which could delay shipments unpredictably. On top of that, as environmental concerns and regulatory scrutiny grew, this model attracted criticism for its carbon footprint and complexity in compliance, highlighting the fragility behind what was otherwise a very flexible supply chain. Shein is shifting its approach by investing heavily in regional distribution centers, including in the US and several European locations, especially in Central and Eastern Europe. Alongside this, they are building partnerships to handle last-mile delivery and returns more efficiently within these regions. The new model centers around using real-time data to spot which products are in high demand, allowing Shein to manufacture larger batches and ship them in bulk to these regional hubs. From there, orders are fulfilled locally, drastically cutting delivery times from over a week to just a few days, while also lowering the cost per item. This regional fulfillment ecosystem reduces the risks tied to cross-border shipping and supports faster, more reliable service for customers. The shift Shein is making isn't about completely leaving drop shipping behind. Instead, it's about blending the advantages of both cross-border and local stocking strategies. For new or untested products, niche items, and trend experiments, they continue to use cross-border on-demand shipping to keep inventory risk low. At the same time, for proven bestsellers and high-demand items tailored to regional preferences, Shein stocks inventory locally. This approach also helps them save on bulk freight costs and better match supply with actual demand. By combining these methods, they maintain the flexibility that help them grow rapidly while adding the efficiency and scale that investors are looking for. Shein uses a powerful analytics engine to decide which products should be stocked locally versus shipped cross-border. This engine looks at several key factors, including how fast demand moves in different regions, the performance of individual SKUs, regional trends, and an inventory risk score. It also calculates the optimal timing and quantity for replenishing stock. By doing this, Shein ensures that warehouses are stocked mainly with fast-selling items that have a high chance of moving quickly, which helps minimize inventory risk while maximizing product availability. This approach supports capital efficiency through high turnover, makes replenishment cycles more predictable, which improves cash flow, and creates a strong data-driven advantage that's difficult for competitors to copy. It also lowers risks related to markdowns and clearance sales, making the inventory management process much more efficient and aligned with the goals of going public. The new model takes a different approach by holding more inventory locally, which at first might seem costly, but it actually helps increase inventory turnover significantly. While the old model kept inventory near zero and had high fulfillment costs per unit, this meant they couldn't really show how efficiently capital was being used. The new model speeds up delivery times and improves conversion rates because customers get products faster. It also allows for bulk replenishment cycles, which makes stock planning more efficient and reduces lost sales caused by stockouts. All these factors together boost revenue quality. For investors, this faster turnover is a strong indicator of capital efficiency, which is very attractive in public markets. The chart here clearly shows that the new model lowers fulfillment costs and delivery days while raising conversion rates and inventory turnover rates compared to the old model. This shift is key for signaling strong operational performance ahead of an IPO. Placing warehouses close to demand centers influences several important operational metrics. By using bulk sea freight shipments rather than sending individual products by air, shipping costs per unit decrease significantly. When the distribution hub is near urban areas, last-mile delivery costs also drop. Faster delivery times are another key benefit. Reducing delivery windows from 7 to 15 days down to 2 to 5 days helps improve conversion rates because customers receive their orders much sooner. Handling returns locally simplifies the process, cutting costs and minimizing customer frustration, which in turn enhances reverse logistics efficiency and improves net margins. Ultimately, faster delivery and smoother returns increase customer satisfaction, encouraging repeat purchases and boosting revenue without the need for additional marketing efforts. This proximity to demand centers is a crucial element in achieving operational efficiency and stronger financial performance. Cross-border shipments, especially low-value parcels, are facing stricter scrutiny in markets like the US and Europe, with political pressure mounting on de minimis thresholds and tighter customs enforcement in the EU. Additionally, air freight is under environmental criticism, adding another layer of regulatory risk. Localizing inventory helps manage these risks by reducing dependence on small-value import exemptions, allowing for bulk imports that simplify customs processes and ensuring alignment with local regulations. This approach lowers the chance of sudden, disruptive policy changes and creates greater resilience against regulatory challenges, which is important not only for operational stability, but also for maintaining investor confidence and supporting a valuation premium in public markets. Reducing costs plays a big role in margin expansion, and this can be done in several ways. Using bulk freight lowers shipping cost per unit, reducing the need for expensive air transport further cuts expenses, and improving packaging efficiency boosts savings when scaling up. On the revenue side, faster delivery encourages more customers to complete purchases, better product availability prevents lost sales opportunities, and keeping customers coming back increases their lifetime value. When combined, these factors drive gross margin expansion, which is essential for achieving a premium valuation at IPO. Even relatively small improvements in logistics costs can add up significantly given the scale we are working with. By reducing logistics costs significantly, especially through shifting from air-heavy freight to a mix that includes sea, land, and last-mile delivery, the gross margins improve considerably. These savings become even more impactful because of the large scale at which Shein operates. On the cash flow side, localizing inventory does increase stock levels, but it speeds up revenue cycles, and faster fulfillment means fewer refunds due to delays. This leads to stronger operating cash flow, supported further by higher repeat purchases. When it comes to capital allocation, investing in warehouses signals a commitment to long-term growth and durability, while building logistics capabilities creates a competitive advantage that's difficult for others to replicate. Together, these factors help move from the cross-border baseline to achieving margins that meet IPO-grade expectations. The key change here is shifting the company's story from being a low-cost arbitrage player, relying heavily on cross-border loopholes, to becoming a mature logistics platform with global distributed infrastructure. This new narrative highlights several advantages that support a higher valuation multiple. First, predictability improves because localized supply chains face fewer disruptions. Then, scalability is enhanced since distributed infrastructure can grow without costs increasing proportionally. Also, the logistics moat created through this model is strong and costly for competitors to replicate, adding defensibility. From an investor standpoint, this shift reduces regulatory risk, leading to a lower discount rate on earnings and justifying higher revenue multiples. Positioning the company alongside well-regarded peers like Amazon and Inditex further supports a premium valuation. Importantly, the logistics side is no longer a cost center, but a core driver of value creation, reinforcing the overall financial and strategic strength that will appeal to IPO investors. Shein's upcoming IPO represents a significant shift from being just a fast and agile exporter to becoming a logistics-driven retail platform supported by mature global infrastructure. This change maintains the original model's flexibility while adding the stability and efficiency that public markets require. It effectively addresses regulatory, operational, and investor concerns all at once. Investors will focus on Shein's ability to deliver products faster, at lower cost, and with smarter logistics compared to competitors, all at a global scale. Logistics has moved from being a behind-the-scenes function to the central factor driving Shein's valuation, with targets like a valuation exceeding $66 billion, cutting delivery times from 7 to 2 days, and achieving over 40% potential margin gains. This transformation tells a clear, compelling story about the company's future and its value in the market. If you found this video useful, there's plenty of more business and finance videos on the channel that you'll enjoy watching and get great practical value from. In the meantime, thanks for watching.